Hello everyone. Today we'll talk about two of the most discussed concepts in the trading world in recent years: SMC, smart money concepts, and ICT, inner circle trader. You've probably heard these terms many times, but most traders are still confused about what they actually mean, how they differ, and how they're connected. In this video, we'll dive deep into what SMC is, what ICT is, their differences, advantages, and common misconceptions. If you're ready, let's start after the intro. Let's begin here. Why did SMC emerge? For many years, traders relied on classic tools like trend lines, RSI, MACD, and similar indicators. These can be useful sometimes, but they often lag behind the actual price movement, meaning they give a signal after the move has already happened. As a result, small traders often enter trades late, get stopped out, or close profits too early. So people started asking, if there are big players in the market, banks, funds, market makers, why don't we just follow their footsteps? That's exactly how smart money concepts was born. So, what exactly is SMC? Smart money concepts, as the name suggests, are the concepts of smart money. Smart money refers to the capital that truly moves the market, the banks, liquidity providers, investment funds, and sometimes even central banks. When they enter a position, the market direction shifts. Our goal is to track their footprints. Let's break down the key ideas behind SMC. Liquidity zones, areas where small traders' stop losses are clustered. Price often targets these zones because big players need liquidity to open large positions. For example, in a trend, there are usually many stop losses. Below the lows, price sweeps them first, collects liquidity, and then moves in the intended direction. Order blocks, candles, or zones where institutions opened bulk orders. These often appear before a major trend reversal. Fair value gaps, FVG, sometimes price moves so fast that it leaves gaps between candles. These gaps show market imbalance, and price usually returns to fill them before continuing. Market structure, reading whether the market is bullish, bearish, or reversing. Higher highs and higher lows signal an uptrend. Lower highs and lower lows signal a downtrend. Now let's talk about ICT. ICT is actually a person, Michael Huddleston, known online as the Inner Circle Trader. He's the one who systematized smart money concepts and shared them for free with millions of traders. In fact, most modern SMC courses are inspired by ICT's teachings. His content is extremely detailed, hundreds of hours long. Here are some of ICT's key concepts. Liquidity. Grab price, pretends to break a level, takes out retail traders' stops, then reverses sharply. A classic form of market manipulation. PD arrays, premium and discount zones that help you identify whether price is expensive or cheap and where it's optimal to trade. Kill zones, specific time windows like the London and New York sessions where big money is most active. ICT focuses heavily on these times because they reveal true institutional activity. Now, how are SMC and ICT related? ICT is essentially the structured educational version of SMC. Think of it this way: SMC is the general concept, while ICT is the teacher who organized it into a system. It's like everyone knows basic math, but a good teacher makes it clear and practical. That's what ICT does for SMC. Let's clear up a common misconception. Many traders think that SMC or ICT are guaranteed profit systems. They're not. They help you understand market mechanics, but you still need risk management. If you ignore stop losses or misuse position sizing, even perfect knowledge of SMC won't save you. Now the advantages. You learn to read the market without relying on indicators, giving you a more professional view. You start recognizing traps that retail traders fall into, for example. While everyone's watching the same trend line, you'll see where the big players are actually gathering liquidity. It helps you build a more systematic strategy. where the market starts to look structured instead of random. Let's see a few practical examples. Imagine EUR/USD is moving upward, but then suddenly drops. Most traders panic and say the trend is broken. But through the SMC lens, you'd realize price first grabbed the liquidity above, then returned to the order block below, meaning institutions collected liquidity before moving on. Another example, a huge fair value gap forms on the Bitcoin chart. Retail traders panic and enter long positions thinking the price is flying away. But you'd know price will likely return to fill that gap before continuing. And sure enough, a few days later, it does exactly that. That's why SMC and ICT have become so popular. They go beyond indicators and show the true mechanics of the market. Of course, mastering them takes time, hundreds of hours of study. But once you grasp the core ideas, the way you see charts will never be the same. In summary, SMC equals the concepts of smart money. ICT equals the person who organized and taught those concepts. They're not rivals. They complement each other. SMC gives you the framework, ICT fills in the details. Now you can confidently answer what SMC and ICT are and how they differ. Drop a comment. Do you use these approaches or stick to classic technical analysis? Don't forget to like the video and subscribe because the next episodes will completely change the way you see the market.